everybody who's here. Good evening. Thank you so much for joining us. Happy fall. We're going to just have a brief overview. Brief meaning we're going to try to keep it to about 45 minutes. If you have a handful of questions, we'll see if we can address those during our time together.
You're currently on mute. Your camera is off, but if you do have questions, use that chat function. You should find it on the menu bar of your Teams meeting, and Matt's going to be monitoring those for us. And like Christy said, we'll try to answer questions at the end of the presentation.
So we're going to do a brief business and individual overview as we barrel toward the end of 2023, which is unbelievable to all of us. Talk a little bit of S Corp Officer Comp, the ERC, the new Corporate Transparency Act, discuss individual deferrals, HSA, dependent care benefits, RMDs, and the qualified contribution deduction, which may be an option for you. Charitable contributions, and just kind of wrap it up with tax deadlines and some housekeeping concerning the upcoming filing season.
So we'll jump right in. First is the business updates. So one thing we wanted to touch on first was for all of our clients that operate S Corp corporations, you are required to take an officer's salary if you have a profitable business. So the reason that we're bringing this up is that we still have time to put you on salary before the end of the year. In order to do that, we need to get in touch with you before December 15th so we can get all the documentation and help you decide on what salary you should be taking based on your profits in the business, what you do, how involved you are in the business. The rules are you have to take a reasonable salary if you are the employee of the corporation. The only way around that is if you're truly passive investment. In other words, you bought a business, you converted to an S corporation, and you hired other people to manage and run it for you, and you're just getting investment income off of it. But if you're actively involved in the business, which most of our clients are, they own the corporation and they're literally the only employee in the corporation. If your business is profitable, by default, you are the only employee and you are required
Even
to take a
if
salary.
this isn't profitable, if you're going to even run at a loss, if you have a significant amount of income,
Yes.
right? I mean,
Yes.
if I'm running at a loss, I still have to take.
Maybe not. So if you are truly running at a loss, the only court cases that have been supported and consistently found in the favor of the taxpayer not drawing a salary are instances where the company has been running at a negative cash flow. So the IRS cannot force you to loan money to your business or force you to take out loans for your business to pay you a salary.
Yeah.
But if you have profit, the IRS can say, well, you need to take a salary then.
Well, that's where they could go into expenses too and potentially disallow them and say, hey, you should
So
pay yourself a salary.
we've seen a couple instances of audits. One is the reason we're harping on this now is that this is a very easy area for the IRS to target and enforce. On your first page of your tax return, if you have an S corporation, the line right below income, the first deduction is officer salary. If that line is zero and your income line at the bottom that says taxable income of X is positive, the IRS can they can run an algorithm that says, if this is positive and this is zero, select for audit.
And if you're taking distributions.
Especially if you take a distribution. Yeah. And so what we're seeing, and Christy's already had a couple clients that have been wrapped up in this where they weren't taking a salary, the IRS selected them for audit, they took significant distributions out of the S corporation, and now the IRS is basically coming back and saying, well, those distributions aren't distributions, that's your salary. And they're determining what is a reasonable salary. Now, we can still argue and we can fight, but it would be much better if we were to declare a reasonable salary for you up front, and we take that decision away from the IRS, and we take away the reason to even select you for an audit. So we are trying to make everybody aware, and we're going to continue to harp on it because as they hire more IRS agents, they're going to be looking for low-hanging fruit, and this is very low-hanging fruit for the IRS.
And this is also where AI is going to get more involved too.
Yeah, and the The other side of that is a lot of the expenses that our businesses are trying to write off are essentially employee-related expenses. So when you think about meals, autos, and all of this, the reason that that's an ordinary and regular business expense is because that's an ordinary expense to be reimbursed to employees. But if you have no employees, they can now disallow all of those expenses as well if you get into audits. So it's very important that we get you compliant and taking the salary that you should be taking. It also offers us some tax planning advantages to do some deferral strategies. So we can couple a salary with a solo 401k and allow you to defer a portion of your income to when you retire, as opposed to paying at a higher income tax bracket today, potentially. So another reason to definitely get in touch with us now and not later, because we can't do some of these strategies in January. We have to do them before the end of the year. The next thing we wanted to touch on is the pass-through entity tax credit. This is a special tax credit that's offered by the state of California, and what it allows you to do is to elect to pay the income tax, your personal state income tax related to your pass-through business income. So if you have a LLC, not a solo member LLC, but if you have an LLC that's run like a partnership, or you have an S corporation, you can elect to pay your personal state income taxes through your business on the income that's passed through from the business. The advantage of doing this is it allows you to take a federal tax deduction on your business, reducing the amount of pass-through income that's taxable to the IRS by paying your state income taxes through your business. You most likely are not able to deduct this as an itemized deduction on your personal return because of the SALT, or the cap on state and local taxes on itemized deductions. So for individuals, you can only deduct up to $10,000 of combined state income tax, personal property taxes, and real estate property taxes. For most people in Southern California or Northern California, property taxes alone are greater than 10,000. So if you pay any state income taxes on your business income, you're not getting any itemized deduction benefit on your personal return. By using this pass-through entity tax credit, you can take advantage of your state income taxes, at least as it relates to your business income. We have an opportunity this year to still do that as long as you make a payment by November 16th. If you've done PTE in the past, you have to make sure that you pay in at least 50% of the credit that you took the prior year. If you didn't take PTE in the past, you can elect in, but you have to make $1,000 payment before November 16th. So if you have a profitable business and it's a partnership or an S corp, you should call us and talk about PTE and making sure you make your payment. Employee retention credit. Two things I want to hit on this, and we could talk about this for hours. The employee retention credit is real. It can be very lucrative. But there are a lot of bad actors and promoters out there that are pushing taxpayers to take unnecessary risks, or promising them large credits that they're probably not entitled to. The reason I bring this up is for two reasons. If you do this with an ERC promoter, the IRS has already targeted this as a dirty dozen tax scheme, or where they see a lot of abuse and fraud. They're going to be doing heavy audits. They've actually already stopped processing the ERC claims since, I believe, early October. And that is on basically a moratorium.
Well, they're not,
Right.
you
They're
you
not
can still
processing.
file.
You can still
track
file
and
the
file.
claim, but they're not processing any, they're no longer working on the claims yet. They're working on their backlog, and they're looking at new ways to identify fraud. And they will most likely, when they do go back to start processing the claims that are in the pipeline, will start asking for additional documentation, or they'll have new fraud techniques to devise to try to identify bad actors. One of the bad actors they're probably going to be looking for is if they see a promoter or somebody that they know is submitting these claims, they're going to target those ones first. They've also given some new programs because they realize that a lot of these taxpayers are being lied to by the promoters, and they want to give the taxpayers an opportunity to withdraw false claims or to voluntarily refund or reverse the credits that they have taken. And they're trying to work out programs for you, sort of an amnesty program, if you will, to reverse if you did make a bad claim. So that's one half of this ERC. The other half is there are a lot of businesses that did qualify and may not have applied for their ERC. If you had employees in 20 and 21 and were impacted by COVID, in other words, your gross income dropped, or you really were forced to close down and weren't able to operate, you're probably entitled to this credit. If you haven't applied for the credit, you still have time. So if you were impacted in 2020 and didn't file the ERC, you have until April 15th of 2024 to file a claim. In 2021, if you didn't file it, you have till April 15th of 2025 to file a claim. So if you haven't and you think you could possibly take advantage of it, please give us a call. Don't call those promoters. Let us at least evaluate and give you the risks of, we may be able to help you, or if we can't, we can at least tell you what to look out for if you hire one of these other companies. Remember, if you hire an ERC promoter to get you a large credit, you're ultimately responsible for signing that tax return and getting the credit. You could be held liable if the IRS comes in and audits you to repay that credit, plus penalties, plus interest. And there's a chance that you could also get hit with a whipsaw effect. Essentially, the audit period for your income tax return, which also has to be amended. So when you receive an ERC credit, it becomes taxable income to the IRS. So you have to amend your income tax return and pay income taxes on the amount of the credit that you received. Now, you do get a credit that's larger than that, so it's still worth filing. But the audit period for the IRS for that personal income tax is 3 years. You have 3 years to either amend it, and the IRS has 3 years to challenge it. Now, the audit period for your ERC tax credit is 5 years. So you could find yourself in a situation where you got a large credit, you amended your income tax return, you paid income taxes on the credit that you received. The IRS waits until year 4, audits your ERC. They say, nope, you weren't entitled to that credit. They force you to repay the full amount of the credit that you received, which, by the way, you've probably given 30% of that money to the promoter as their fee.
And they're
And
gone.
they're gone. You're not going to be able to get that back. Now you got to pay back the full amount of the credit. And you think, oh, at least I can re-amend my tax return and I can get back the money that I overpaid on taxes. But you can't because they're out of the statute of limitations. So you're not able to get any credit for the income taxes that you already paid, that you overpaid, and you're going to have to pay all of the money back that you received, plus penalties, plus interest. You could literally find yourself where you're paying 130% of what you actually received.
Yeah.
So it can be ugly, and that's why we're telling people, if you feel that you may have been duped by a promoter, call us and let's see what we can do to get in front of it, and not wait for the IRS to come after you. Another good strategy for businesses, and this applies to all businesses essentially. If you're a sole proprietor, if you're a partnership, if you're a solo member LLC, if you have a corporation, if you have an S corporation, one way that you can help to lower your income taxes for the current period is to invest in your business. If you were thinking of buying a new truck for your business because your business requires you to have a vehicle, you could buy that vehicle, put it in service before the end of this year in December, and take a write-off basically with bonus depreciation and Section 179 deduction that would allow you to accelerate the depreciation on that asset and take the full expense for federal tax purposes in year 1 or in 2020 for 2023. This is true for federal. It's not true for California. I think, Christy, you've talked with a couple of clients that were surprised, right? That
Especially buying the heavy vehicles
yeah,
that were absolutely clear to take the 179,
Mhm.
and they ended up paying.
And they wound up
A
still
lot of
having to
California
pay, still have to pay
because
California tax because,
California will not conform. They will only honor $25,000.
so you bought $100,000, 6,000 pound SUV. For federal tax purposes, they let you write off $100,000. For state tax purposes, you have to depreciate that over 5 years, and you can only write off 25,000 of it the first year. So you thought you were going to get the full tax savings on both federal and state. You're really only getting the full tax savings on federal. Now that is the bigger portion normally, but people are often surprised they still have to pay California tax. So we just wanted to warn you.
This is lots of asterisks on this one.
This is a new reporting requirement that the federal government is coming out with. It's going to start January 1st, 2024, and it's called the beneficial ownership
Beneficial ownership information report.
return. So this is operated by FinCEN. It's the same arm of the federal government that was in charge of reporting of foreign bank accounts for people that were trying to hide their income offshore. This is designed to find shell companies that are being used for money laundering by drug cartels, traffickers, bad people. But their target, the way that these companies work is that they're going after smaller businesses. They don't launder money through the large corporations. They don't launder money directly through banks in most cases. They launder money through smaller businesses. If you're ever interested, watch Ozarks. It's all about how they launder money through small businesses. This is targeted to find who is the owners of these small businesses.
Are any of those bad actors' names actually on the
No, which is the biggest problem with this, right? Is the bad guys aren't going to follow it, but the good guys are going to get penalized for not doing
Yeah.
it. So unfortunately, this is again sort of a big net that is going to swallow everybody that has a business entity. And we're talking all entity types as far other than sole proprietors. If you have an LLC, a solo member LLC, a partnership, a limited partnership, an S corporation, a small corporation, all of those are going to be required to make this report. And you're going to have to report and provide copies of driver's license, passports, personal information, personal contact information if you own a small business. There's a lot of caveats. There's a lot of information that's still coming out. The law is currently written that it goes into effect January 1st, 2024. So in a little over 7 weeks, 8 weeks. So for any entity that was created before January 1st, 2024, you have a year to comply. You won't have to make your initial report until you can do it earlier after January 1st, 2024, because the system's not up yet. But you have until January 1st, 2025 to do your initial report.
Is this a one-time report or is it every year similar to the FBAR?
It's a annual report from my understanding, and it's anytime there's a change in ownership.
I was gonna say.
Yeah, so it could be multiple times in a year if you have, especially for like some of our real estate clients that have a lot of investors, right? That if an investor changes, that's a change in ownership, they may have to update it. Now, they have to be a beneficial owner, so it has to be greater than 25% control. But the tricky part about this, and this is why it's still signatory or influence.
But who doesn't? Yeah.
How do you define that? They haven't really defined it, but they're trying to find out the people that, even though they don't own anything, are still in control of the corporation.
Well, yeah, and what about production LLCs once everybody starts working again too? I mean, those are just for every.
Yeah.
This is a mess.
So it's going to be a nightmare, but it is something that's going to happen. And if you have, like I said, if you have an entity prior to January 1st, 2024, you have till January 1st, 2025 to do your initial reporting. There is no paper filing for this. It will have to be done electronically. It will be monitored and managed by the FinCEN, which is a separate arm of the federal government. It's not part of the Internal Revenue Service. And there is some debate as to whether accountants will even be able to help their clients with this, because it could be construed that this is a legal document. And as such, we're forbidden from practicing law. So you may have to, if you have questions or you don't know whether you're doing it correctly, you may have to consult an attorney to.
Jury's still out on a lot of this, and we'll keep you updated as we learn more, because the penalties are steep.
I need to go back one. Sorry.
Sorry.
On that, I said if you had an entity that was created before January 1st, 2024, you have until January 1st, 2025 to report. However, if you start a new entity in 2024, you have to report within 30 days of creating your new entity.
As of what we know right now.
As of what we know right now. We've heard rumblings that they may extend this to 60, they may extend it to 90. But right now, the way the law is written, you have to report within 30 days. Another thing to hit, there is no tax associated with this reporting. However, there are significant penalties, including heavy fines and prison time if you don't report. It's a scary law, so be careful.
Okay.
Yes.
Kids on company payroll. A lot of our clients are doing this, they're adopting this strategy. And it's a good one. And there are some advantages to this. You can go ahead and basically do some cash management and shift $12,950 up to the standard deduction without your kids incurring additional federal or California income tax.
Yeah. So if you have to have a valid reason for hiring your children. You can't just put them on there and not have them do anything related to the business. But it could be actually doing office work around the office, or if you have some sort of manufacturing, they could help out at the thing. It could be
Social
advertising, it could be social media monitoring, it could be a number of things, but it is a nice way for you to transfer family income that normally would be taxed at your rates down to your children, where they don't have to pay any income tax. And a lot of our clients tell the child that, look, we're going to use this money to help pay for your education. We're going to use this money to help pay for other summer camps or other things that you can do.
Yeah.
But it's a nice way for you to get that money non-taxable to you, use it for the kids' welfare, and they don't have to pay any income tax because they still get the standard deduction. Another nice benefit here is they will have now earned income. And you could literally also set them up either with the money you pay them from the company, or you want to gift them additional money because they have earned income. You can set up a custodial Roth IRA for the minors. If they're over 18, they could open up their own IRA account. You could gift them that money, or like I said, use the money that you're paying them from the business.
Roth, you can be any age. It doesn't have to be earned income.
Well, they have to have earned income.
Exactly, earned income.
Yeah, but they can be any age. Yes.
It's terrific, because ideally, your kids are going to reach a certain point, hopefully in their 20s, where they will not potentially be eligible to contribute to the Roth. So you could feasibly have 100 grand socked away.
Yeah. That's $6,000, 65, 7,500.
Yeah.
If you put them on payroll at 12, by the time they're 18, 19, 20, they could have 8 years at $7,000. They could have 56,000 set up in a retirement account.
Yeah.
Growing tax free, that they would never theoretically have to pay income tax on.
It's almost it almost rivals a 529 plan. Not a 529.
I do. Yeah. I like a Roth better than a 529 because there's a lot more flexibility on how that money can be used, and it's not restricted to just education.
Yeah. Okay.
Individuals. So some more tax strategies for individuals, especially now that open enrollment is here. So we're switching from business now to all individuals. One thing that you can do is with open enrollment is take a look at what you're deferring through 401k, or if your company is public, it may be, or government, you may have 403bs instead of 401k. But you have a lot more you can contribute, or higher limits that you can contribute into these type of plans than you can with a traditional IRA or Roth. So where an IRA caps out currently, if you're under 50, you can only contribute up to $6,500 a year. But if you have an employer that has a sponsored plan, a 401k or 403b, you can contribute up to 22,500. And if you're over 50, you can add an additional $7,500. So it would bring it up to a total of 30,000 if you were over 50. With um, an IRA or a Roth, you can only add another $1,000 if you're over 50.
And there are limitations to the deductibility of your traditional IRAs.
Correct.
And the contributions to the Roth, like we were just talking about, but you can make 500 grand and you can defer
under the max. Yeah. So 401ks, if you're looking for ways to defer income and to maximize the amount that you can contribute, you should be looking to your employer's retirement plan and not to a traditional IRA.
And if they match, you definitely want to contribute.
Yes, if they have a match, which a lot of them will do, even the smaller ones, because they need to follow safe harbor rules so that the owners can contribute maximum amounts. You should always take advantage of at least the match amount because they're giving you free money. If you don't take advantage of it, you're losing out. Another tax deferral strategy for people that work in larger corporations and even self-employed people, if you want to get a health savings account, this is similar to like a medical IRA if you want.
They call it a secret IRA.
A secret IRA. Yeah, so the trick is that you have to make sure that your insurance qualifies to have a health savings account. You can't use the health savings account with any medical insurance. The medical insurance you have has to be high deductible, high premium.
So 1,500 single, 3,000 for family plan.
Yeah. So if your HR department or your insurance provider can tell you if the insurance would qualify for an HSA account. If it does qualify for an HSA account, contributing to a HSA makes a lot of sense. You can contribute if you're under 50 and it's for just you, you can contribute up to $3,850 into this health savings account. If you're covering yourself and your family members, you can contribute up to $7,750. And if you're over 55, you can add an additional $1,000 on top of those. As long as so again, you're investing into a health savings account. That health savings account can be invested similar to like an IRA or another retirement plan. The money that it earns is not taxable. The money that you contribute in is pre-tax dollars, meaning you don't have to pay income tax on that money that you contribute. You essentially get to deduct it from your taxable income.
It's not either.
No, it's yours. And even if you were to later change insurance policies or go on Medicare, if you had a health savings account in the past, you can still use that as long as you use as long as whenever you take money out of that account, you're using it for health related expenses. The money you take out is not taxable. So it's a great way to defer income. It's a great way to earn or invest your tax deferred income and never have to pay income tax on the proceeds.
RMDs. This is the tongue twister.
Yeah. So the minimum required RMD stands for required minimum distributions, which means that all those monies that we've been deferring into retirement accounts, when you reach a certain age, the IRS will force you to start withdrawing money
from your 401k, from a SEP,
from an IRA. The only one that it won't force you to take a distribution from is a Roth, and the only reason they're not forcing you to take it from a Roth is because you already paid tax on the income. Now in 2022, the minimum, the max, once you hit 72 in 2022, you were required to take an RMD. Now, your first year that you turn 72, or the first year that you hit the age for a required minimum distribution, the IRS gives you the option of either taking the required minimum distribution that year, or by the original tax due date, which was April 15th of 2023. So if you turned 72 in 22 and didn't take your RMD in 22, you were supposed to have taken your first RMD by April 15th of 2023. And you have to again take another RMD in 2023 for your 2023 RMD. And that has to be done by December 31st. Now, if you live in California for this year, that 4/15 due date got pushed till November 16th. So you still have time if you didn't take your April 1st, 2023 RMD, but you need to take that April 15th RMD by November 16th or a couple weeks, 8 days from now. So if you haven't done that or you don't know how to do it, or this is the first time and you turn 72 in 2022, call us or call your financial advisor that has your IRA and make plans to take your RMD.
And they should have been sending you notices. When
They should.
reach that age as well.
Now, this is the weird part. So if you turn 72 in 2023, it doesn't really matter because you were required to take your RMD starting in 2022. So you still have your thing. But if you turned if you turned 72 in 2023, you're not required to take an RMD in 23
CARES 2.0.
because now it's a change. The required minimum age has been increased to 73. So there is no RMD for you in 23. Your first RMD won't be due until 24. And because you turned 73 in 24, you have until April 15th of 2025. But you'll have to take two in 2025 if you wait. So you may still want to take your initial RMD when you turn 73 in 2024, but you could wait until April 15th.
You should be getting notices from your brokerage regarding this.
And if you're still confused, feel free to call us.
We'll confuse you more.
This is a nice way for you guys that are older, have to take an RMD from your IRA, make charitable donations or regularly make charitable donations, but may not be able to itemize because you don't have mortgage interest anymore. You just don't have that much to itemize as far as deductions go. This is a way for you to get benefit. And what happens is you can have your IRA or your 401k administrators, whatever, make a direct payment to a qualified charitable organization. And what that does is that amount that you contribute, that the IRA contributes in your name via your IRA is no longer taxable. So on your 1099 that you receive at the end of the year showing your distribution, you would have a distribution of, let's say, $40,000. That's your required minimum distribution, but you had them pay $10,000 to your house of worship directly. You would have 50 or 40,000 as the distribution in box one, but in box two, the taxable amount would be 30,000. So it doesn't even show up in taxable income. They just take it right off the top.
Like an automatic above the line.
It's an above the line deduction. Exactly.
Beautiful.
And you still, if you were still getting a standard deduction, you still get 100% of your standard deduction. Plus you don't have to pay tax on $10,000.
If you inherited an IRA or 401k, you can use the same strategy. If you're locked into that,
like if you have to empty that account in 10 years, you don't have the money, or you don't need the money, and you don't want to have,
or you don't pushed into, and you typically give X number of thousands
and you're giving money anyways to a charity. This is a great way to do it. This it can be used up to $100,000 every year per person. So if you're married, it can be 200,000 if you and your wife both do it, or you and your spouse. It reduces your taxable income, and it's a great strategy for people that can't itemize.
Donations.
So donations, there's very few items nowadays with the tax changes that were made back in 2017 for individual people that earn wages or have investment income to impact what they can deduct. So when you think about itemized deductions, the only one that you really could control is your charitable donations. You could maybe argue for medical, but you still have to get over a hump. And who wants to pay extra for medical?
Well, no.
Yeah, you don't want the deductions. So this is a great way that you can maximize if you are able to get over itemized deductions, and you can get over the standard deduction. And those bullet points there are the current standard deductions for 2023. It's going to be $13,850 if you're single or married filing separate, $27,700 if you're married filing joint, or $20,800 if you're head of household. If you're over 65 or blind, you get an additional exemption or deduction.
Both,
You get both.
double.
You get 1,850 for being over 65 and 1,850 if you're legally blind. You can deduct up to 60% of your AGI if you make cash. We say cash, but we're talking checks and credit card donations. And or you can deduct up to 30% of non-cash, goodwill, etc. Just a reminder, we don't necessarily need this documentation when we file your tax return, but you need to have this if you ever get examined by the IRS. If you make a credit card or check donation greater than $250, you should receive from the charity you made the donation a letter that states that they received your donation for this amount and that you received no goods or services in exchange. Without that letter, if the IRS examines you and if they decide that they don't believe that this was a donation, they can disallow the itemized deduction. So it's very important that you get and retain those letters from the charities that you're donating to. The other thing to remember on non-cash donations is there's different rules. If it's under $500 that you're claiming is being donated, we just need that dollar amount that you've claimed, and we put that on your tax return.
It's kind of like a safe harbor.
Yeah, anything 0 to 500, the IRS just wants a number. Now, you still have to have substantiation. If you were to get caught for an audit and you said, I gave away $500, you need that little Goodwill receipt or something that says you went to Goodwill on this date and you donated these items and you estimated the value to be X. But that's about all the substantiation you need. From 500 to just below 5,000, you have to provide more information on your tax return when you file. You need to provide the date that you made the donation, the name of the organization you donated to, the address and phone number of the organization that you donated to, a list of the items that you donated, when you originally purchased, it could be various, and when you donated, the date that you donated, as well as the dollar amount that you're claiming. I also highly recommend that you take pictures of the items that you donated, save them in a folder.
Even if you're using our Smart Vault, which we really would like everybody to use, feel free to take your pictures, upload them to the vault.
Yeah.
A lot of this you can do over the course of the year.
Yeah. We don't need them. Like I said, we need the information so we can put it on the tax return, but we don't actually submit the pictures. We don't submit a complete inventory. We usually write a summary description of what you gave and a dollar amount. But if it's between that 500 and 5,000 that you're claiming, you should keep detailed records of what you gave. Pictures will help substantiate, but you don't necessarily need a third-party appraiser. The minute you get from 5,000 up, you do need to have a third-party appraisal to claim the deduction, and we have to literally scan the copy of the appraisal and submit it with the tax return as an attachment. The important thing here is it's not a $5,000 if the donation you made was greater than 5,000 on the date that you did the donation. They take an aggregate for the whole year of like-kind donations. So if you regularly go to Goodwill and contribute $500 a month of clothes, at the end of the year, you will have donated $6,000 worth of clothes. Now you're over the 5,000. We can't claim the $6,000 that you donated in clothes without a third-party appraisal. So if we're at that point, we would probably tell you we're only going to deduct $4,999 because we can't go over the 5,000. And it's going to be difficult for you to get a third-party appraisal if you do it after the fact because you don't have the clothes items anymore. So if you want to do it and you want to get a large deduction greater than $5,000, I don't recommend doing it in small donations. I recommend in gathering it all up, hiring somebody to do the appraisal, and then to making the big donation at one time.
There's some thrift shops that'll do that for you.
They will, but you have to be careful. The documentation has to be a third party appraisal. It can't be related. So it's just something to keep in mind. Another strategy for our individual clients, especially those that have investment portfolios, is working with your investment advisor before the end of the year to do tax loss harvesting. What that means is you may have items within your portfolio that have lost money since you purchased them, and maybe they're not anticipated to ever bounce back, or they're going to bounce back, but it's going to take a long time, and you could reposition into a different asset category and probably get a bounce back faster or return on your investment faster. By taking a tax loss and selling that item off before the end of the year, we can use that loss to offset any capital gains you may have realized over the year. And an additional, if you don't use it all up against capital gains, we can take an additional $3,000 of that capital loss against ordinary income from other sources. So it's a great way for you to minimize your capital gains tax, but also dent your ordinary income by that additional $3,000.
Be careful you're not in a wash sale situation before you do this again. So you definitely want to talk to your advisor.
Yeah, wash sales happen where if you sell a stock and then immediately buy that same stock back within 30 days, and there's some other rules around this, so it's not as simple as that, but it would negate the loss essentially. You wouldn't have a capital loss anymore if you immediately buy it back. So you cannot sell something at a loss if you immediately buy it back the next day. There was people that used to do that. They'd sell everything off on December 31st, buy it back on January 1st, try to take the capital loss. The IRS stopped that by saying you have to wait a minimum of 30 days. And there's some other rules around those buybacks. But there is nothing stopping you from selling off and then buying a different type of asset, selling GE and buying Amazon. So there are ways around the wash sale rules, and there are ways to harvest your losses, but your financial advisor can help, or we can help as well if you have questions. The other thing you can do with losses is if you sell it for a loss and you want to make a donation, let's say you don't decide to go back into the market, you just want to harvest your loss, you can sell the item, take the capital loss. You can also take the proceeds from that capital loss and do a donation. And take a charitable deduction for it. So you get a sort of a write-off and a write-off. The other thing is the flip side of that is also true. If you have appreciated property and you don't want to pay the capital gains on it, let's say you bought Apple when they were still in the garage and have been holding it for 30 years, you could sell that and realize the capital gains, or you could donate that to your favorite charity. You would get the full fair market value of the stock you donated
as a
deduction, but you would not have to pay any capital gains. So it's a nice way to donate extra money to your charity and for you to avoid having to pay tax. All right, so I think that wraps us up with the tax updates, the tax notes we have for this year. I just wanted to remind you for 2022 tax year, which is what we've been filing for most of 23. If you are in California and don't live in the top 3 counties in the northeast corner of the state, your final due date was November 16th, was the final extended due date that they allowed everybody to file. Now, for most clients, we filed you before October 16th, and you've already made your payments. But for those that haven't made your payments, you're not late yet. You still have until November 16th to make your final payments, and you wouldn't incur any interest or any penalties. This includes if you haven't made 2023 estimates to date, you could make your first, second, and third quarter 23 estimates, technically your fourth quarter 22, but like I said, most people have already paid. But your first, second, and third quarter of 23 estimates that are normally due in April, June, and September aren't due until November 16th. So if you haven't made those, you still have another 8-9 days to make those payments and not have to pay any underestimated tax payment penalties. Now we're rolling into 2024. In 2024, we're going to be preparing your 2023 tax year. The 2024 deadlines are not likely to be extended, or we cannot assume that they're going to be extended. So we're going to revert back to the normal due dates. Your 1099s, if you own a business and have subcontractors or make miscellaneous payments to other vendors, you have to file your 1099s by January 31st of 2024. We'll be sending reminders out to our business clients that if they need help with this, we can assist. But you should keep on your calendar that these forms are due both to the government and to the recipients by January 31st.
It's a great time if you've had individuals working for you who maybe you haven't collected a W-9 from, go ahead and start collecting that information now.
Yes, and start gathering your information so that you can get this, because you don't have a lot of time. You got to wait till the end of the year if you're still making payments, but you only have 30 days to gather all the information and do the reporting. So just be aware of that due date. For partnerships and S corporations, your due date for your income tax returns are March 15th of 2024. For C corporations, individuals, and trusts, assuming that you're on a calendar year, is April 15th of 2024. For all but the 1099s, you can get an extension for 6 months to file. It's important to remember, though, the extension is not an extension of time to pay. Unlike this last year where there was some special, there was the FEMA declared disaster area, they actually extended the payment due dates till the end of the year. You won't have that opportunity next year. If you're going to owe tax, you need to plan to pay tax by March 15th and by April 15th. So keep that in mind.
Call us if anything you heard struck a nerve or you have additional questions. Get on our calendars. We'll be sending engagements out for 2024 shortly after Thanksgiving. And we'd like to wish everybody a really lovely holiday season.